All right. So we're looking at market ratios, which measure how investors value a company's shares in relation to the earnings, dividends, and the book value. All right. So we're going to start with the first market ratio, which is earnings per share. So basically, earnings per share is just saying from the total profit that you've made, how much is each shareholder get? How much can each shareholder get? Okay. From the profit that you've made, remember in your financial statements, in the income statement, after you get your net profit, all right, and you remove away the preference dividends, the preference shareholders. Now, from that money, that profit that is remaining, how much is each shareholder likely to get? Okay. The higher the earnings per share, the better it is. Okay. Although in actuality, usually companies are not going to pay off all that profit to every shareholder because they need to keep some of it. Okay. But in a scenario where all that profit is distributed to each shareholder, how much should each shareholder get? So this is the formula here. Profit after tax minus the preference dividends. Colleagues, I hope you remember the difference between an ordinary shareholder and a preference shareholder. Do we remember the difference between both ordinary shareholder and preference shareholder? Madam Jean, do you remember? Madam Jean? Okay, wonderful, wonderful. All right, so yes. So this is how you interpret earnings per share after you've tabulated it. If you get an earnings per share of 2 kwacha, means the company earned 2 kwacha profit for every ordinary shareholder. Okay. So if you own one share, it's like you're getting a 2 kwacha profit from the company. Any questions, colleagues? Now, colleagues, for example, if a company's earnings per share is going down, how can they improve it? How can they improve the earnings per share? If a company, a listed company, the earnings per share has gone down. Let's say last year it was 5, then this year it's 2. How can they improve this ratio? Mm, by making more profit, yes. That is the key there. Okay. Because if you increase the number of ordinary shares and that increase is more than the increase in the profit, it will drop. Because if you increase the number of ordinary shares, it means now the profit has to be split to multiple shareholders, more shareholders. So the ratio will eventually drop. Let me just open this document. I don't know why it's freezing like that. Yes. All right. The next is the price to earnings ratio. Okay. How much investors are willing to pay for every 1 kwacha of earnings. Okay. how much investors are willing to pay for every one quarter of earnings of the company. So, colleagues, with this ratio, if investors are willing to pay more for every one quarter of the earnings, then it means that company is doing well. Okay, that's why they're willing to pay more. They want to, because the company is doing well, and they want to invest and also have a share of those profits. Okay, but if the price to earnings ratio is low, then low investor confidence. Okay, so a higher PE ratio, it tells you, okay, this company is doing good. All right, it's a possible company which you would like to invest in. All right, a lower PE ratio, um, then you will be able to say, okay, there's not a lot of confidence in this company. Right? Yes. So this PE ratio is the market price per share, how much each share is being sold for in the stock market, over the earnings per share. Okay. Yes. So, for example, if you have a PE ratio of 10, what it's telling you, investors are willing to pay 10 kwacha for every one kwacha of annual earnings. Okay. Yes. Any questions, colleagues? So if a company is yes, yes. Someone raised their hand. I can get you. Yes. If that company is making profits and their share price is increasing, then what that's going to signal to investors that that company is being successful. So the more successful a company is, the more investors are willing to pay for every one quarter of earnings for that company. But if a company is doing bad, then investors are going to they don't want to pay a lot for the earnings for that company. They want to pay less. So basically, this ratio is just showing the confidence that investors have in certain companies. Like for example, if we look at SpaceX and what's this Tesla, that company is doing well. Okay, they're doing well with the solar cars, these space travels. So investors would want to invest in that company. All right, they would want to invest in that company. And remember, when people want to invest it, when the demand for your shares increases, it means even the market price of your shares will increase. So what that will signal to investors is this company is doing well and they'll be willing to pay a certain amount, all right, to be part of your company, basically. Is that okay, madam? It is showing investor confidence in companies. Was the madam who asked? Are you there? Yes. So if you see, for example, Zambia, if the price to earnings is 25 kwacha, and then you see maybe another company like Trade Kings, the price to earnings is maybe 10 kwacha, you'll be able to tell that, okay, Zambia, oh, there is obviously they are winning this side here. The company is doing well because investors are willing to pay more versus Trade Kings. Okay, next is dividend per share. Okay, how much each shareholder is getting as dividends, basically. All right. It is the ordinary dividends. This is the money that's going to be paid to the ordinary shareholders, divided by the number of ordinary shares. Okay. So if we hear dividend per share is 1 kwacha 15 ngwe, it means if you own one share, the dividend that you're getting is 1 kwacha 15 ngwe. Right. So this ratio, you're actually seeing how much the shareholders are getting. So a higher dividend per share, it means shareholders are getting more. A lower dividend per share, shareholders are getting less. Okay, so if you want to invest, you would want to invest in a company where the dividends are more. Okay. Yes. Any questions on this one? Okay. All right. Dividend yield. Okay, it's just telling you the return each shareholder is getting in percentage form. Okay. Dividend yield shows the cash return investors receive from dividends relative to the market price of the share. So basically, it is just telling you what your return is in percentage form. Colleagues, just hold on. Let me just get this call. Hello. Hi, how are you? Hello. How are you? Can I call you after my class? I'm calling right now.